Are you ready for a crazy week? If you are not, you better get ready because the trading week starts tomorrow and things are going to heat up pretty quickly. Now, in this video, we are going to be your guide for everything you need to know about this week. We're talking earnings. What companies? When are they? Why are they important to the markets? Economic data. Same thing. Why is it important to the data? Fed Jerome Powell is also going to be on Wednesday. And what this week is really going to do is set us up for AMC earnings that are estimated to come on February 28th. Meaning that if the markets do not crash after all of this new information that we get, earnings, Fed Jerome Powell, and economic data, then you're going to look a lot more bullish than not heading into AMC earnings a month from now, because these are the things that will be the reasons the markets crash in 2023 or the markets rally in 2023, or should I say continue to rally, because the markets have certainly rallied quite a bit compared to what we've seen in 2022. Now, guys, let's get straight into this video. We have a lot to cover in a very short amount of time. We're going to go over the Ortex data, Stonko tracker data, everything you need to know will be in this video, and to some degree will be a guide. If you guys want to save this video, hit the like button so you can come back and rewatch this video as you progress throughout the week. I think that would be very valuable to all of you guys, especially if you are watching this economic data or the Fed or earnings and trying to make some money off of it. So let's get into this information, guys. And first thing you need to know is specifically why this week is so important. You have the Fed on Wednesday, and I think that's actually not as important as earnings. And we'll talk about what companies report earnings on what days. But Fed Jerome Powell will still be important, but I think the bigger concern is what the economic data is going to do, what earnings are going to look like compared to 2022 when the markets were concerned about how high is the Fed going to go. The markets are already pricing in Fed rate cuts by the end of 2023, or at the very least, the markets expect the Fed to get rates to about 5% and keep them there. So it's not like we don't know where the Fed's going to go. It's not like in January of 2022 when you thought the Fed was going to raise rates 3 times, maybe 4 times, and they ended up raising rates to 4.25%, right? They just kept progressively getting more and more hawkish. Well, you're not in that environment right now. You're a lot closer to the end than the beginning as far as Fed tightening. But think to yourself, ultimately, what do the markets care about? They care about a recession. They care about valuations. They care about earnings. The Fed raising rates, all that literally does is slow down the economy and get you closer to a recession. So ultimately, the Fed raising rates, the markets only freaked out about that in 2022 because we were fearful of a recession and earnings going down. Now the question in 2023 is that going to happen? Is what the Fed did in 2022 now going to bite us in the booty hole in 2023? And this earnings, you are going to get those answers. Now, some of the soft data that we are getting doesn't look too encouraging for this earnings season. Now, Microsoft did have decent earnings. They lowered guidance, which did not react positively with the stock. Tesla had pretty good earnings, but those companies, relatively speaking, don't matter. We already know Microsoft has a very good business model. Microsoft is the top company, in my opinion, that is the least volatile. Businesses need Microsoft software. That's just a fact. So they're going to be like one of the last hit companies out of all of this. Some of the first hit companies are going to obviously be Google, Amazon, most importantly, Apple. And something we got that came out last Thursday doesn't boast well for those companies, specifically Amazon and Apple. Now, what we actually got last week was this news from Hasbro that they're way off their holiday forecast. Hasbro was expecting $1.98 billion of revenue for Q4 for the Christmas holiday season, and they came in at 1.67 billion. That's a huge miss. That's like a 25% miss. I don't think that looks good for Amazon or Apple heading into their earnings. Now, that's Hasbro, a consumer discretionary. Apple is also a consumer discretionary, but a little bit of a stickier business model. A kid don't need a new toy or a new board game, but you might need a new iPhone if yours breaks. So a little bit different there, but some of the data that we're getting from some of these retailers or just consumer discretionary companies is not looking good. So if Apple and Amazon have bad earnings on Thursday, that's it. The stock market will go through a lot of pain, like not a little, a lot of pain as investors try to figure out what are the numbers going to look like for 2023. Is the markets overvalued right here? Should we be trading at 360 again on the S&P, or are the current valuations warranted? Now, I will say the markets have rallied quite a bit ever since the start of 2023, so to give some of that back would not necessarily be a huge shocker. At the same time, you've rallied so much, you're kind of already pricing in better earnings than what we were a couple of weeks ago, certainly better earnings than a couple of months ago. So that gives me a little bit of a concern, at least for Thursday earnings. Amazon, Google, and Apple in after hours. Wednesday, you're going to get Facebook. Tuesday is AMD and Snapchat. Monday is SoFi. These are the most important company earnings for the S&P 500 as a whole. Tuesday pre-market, you will get UPS also, and that can be a big one, especially if they miss or surpass earnings expectations by a big margin. If UPS has great earnings, that's going to look really good heading into Amazon, right? How could you be bearish on Amazon if UPS kills earnings Tuesday morning? If they don't, well, that could start this very bearish view towards earnings throughout the rest of the week. So I think a lot of the action in the markets is going to start on Tuesday, believe it or not. And really by Thursday, or I should say Friday, because you get these earnings Thursday and after hours, you're gonna be saying to yourself either, we got through earnings, it's okay. Or you're gonna say, yeah, we're probably going into recession, or at least an earnings recession, and the markets have a considerable way to go before we hit a bottom. So that's what you have in store for earnings. Now, on the front of economic data, there is also no shortage of that. Now, Monday, you don't have anything, like literally no economic data. On Tuesday, you're going to get the S&P Case-Shiller Home Price Index, month over month and year over year. You're expecting the year-over-year number to come in at 6.5%. The last month reading was 8.6%. So you are expecting, obviously, home prices to continue to decline. And I don't think that's going to be a huge catalyst for the markets, but it can give you somewhat of a move. And I think it's worth pointing out here in this video. Now, you're going to get the ISM Manufacturing PMI at 10 o'clock in the morning on Wednesday, and the JOLTS job openings as well at 10 o'clock in the morning. You're expecting 9.5 million job openings. Last month in November, you had 10.5 million job openings. So the markets want to see this number come down, and I don't think that's going to be super bad if that does happen. Now, keep in mind, in 2022, bad news was good for the stock market. With this narrative that I have already laid out to you guys with this recession or a possible recession or earnings coming down, bad economic news is going to be bad news for the stock market. This inversion, for lack of a better word, that you have seen in 2022 is no longer the case for 2023. Let me repeat myself. Bad news will be bad news for the stock market, or should I say bad economic data will be bad news for the stock market. 2 o'clock in the afternoon on Wednesday, you get the Fed interest rate decision. We already know they're going to raise rates by 25 basis points. If they do anything different than that, if they go 50 basis points or don't change them at all, it could give you a pretty decent sell-off. Even if the Fed does not raise rates, you could still see a huge sell-off based off of that, because why is the Fed not raising rates now? Why did they forecast almost 5%, a little bit over 5% and they're not raising rates. Now, the markets have firmly priced in a 25 basis point rate hike, and the Fed almost always goes with what the markets are pricing in. So pretty well known we're going to get that. More importantly, Fed Jerome Powell and his guidance for the rest of the year will be important to the markets. Now, Thursday, you're going to get, like I said, the earnings, right? You're going to get Apple, Amazon, Google. That's going to be the most important thing. But you also, at 8:30 in the morning, get initial jobless claims for January 28th. You're expecting 187,000 initial jobless claims. So you're not really expecting a lot of people to file for unemployment for the week of January 28th. So I don't think that's nearly as important as the earnings or Fed Jerome Powell. So by this point, you're going to probably be in that earnings sell-off or earnings run-up phase in the markets. Now, you're also going to get at 8:30 in the morning the unemployment rate for January and the non-farm payrolls for January. You are expecting the unemployment rate to go up by 0.1 to 3.6%. Last month's reading was 3.5%. Non-farm payrolls for January, you are expecting 190,000 jobs added to the economy. Last month, you had 223,000 jobs added to the economy. And this seems to be one of those data points that always is better than expectations. So I expect probably the same thing. It's probably going to be better than 190,000 jobs. And like we seen last payroll report, it did not cause a sell-off because the markets are more concerned about a recession and economic data getting worse and leading us into a recession than good economic data. Good economic data is good news for the stock market in 2023. That is a fact that you need to ingrain in your mind. That's it. As long as inflation continues to go down, good news is good news. Bad news is bad news. You're back to a normal market in 2023, as normal as you can be when the Fed's raising rates to 5% at a historic pace, and we're waiting around to see if we're going into recession or not. Now, ISM non-manufacturing PMI will also come out at 10 o'clock on Friday. So by this time, you're going to be breathing a sigh of relief, or you're going to be questioning why you didn't sell your whole portfolio just a couple of days prior. Hopefully that gives you the gist of this week. Now, let's get into some of the data behind AMC stock, and then we will go ahead and wrap up this video. And why I like to go over these broad market concepts, the economic data, the Fed, the earnings rundown for this week is, like I said, it will set us up for AMC earnings coming on February 28th. If the markets do at least stay flat or even go higher into AMC earnings, it's going to give you a landscape that could reward AMC, possibly giving us a free cash flow number or a net income number a lot more. If the markets are selling off and people are selling everything because earnings, say Apple was 25% worse than expectations and the markets crash, it's going to be a lot harder for AMC to react positively, even if they have really good numbers, because who even cares if the markets are crashing, right? Hopefully that makes some sense to you guys. And that is why this week is important. After this week, you're not going to have anything that will move the markets down in a big way until you get inflation data. But at that point, we already know inflation is going to continue to come down. It's a pretty well-known fact right now. It's going to have to take some real wonky figuring in the numbers to get a spike in inflation again. It's just not going to happen. There's so many deals out there. You're starting to see deflation. Now, as far as AMC, the live short interest off free float is 22.9%. The amount of shares currently sold short sits at about 118 million. So again, record numbers that we are seeing with AMC. Cost to borrow average at 161%, cost to borrow max at 351%, and cost to borrow minimum at 1%. Cost to borrow average at 103%. So again, the numbers are insane. I mean, these are record numbers. There's never been a better time since June of 2021 to be bullish on AMC, in my personal opinion. Now, days to cover, 6.39. Cost to borrow, 210%, the 3-month trailing average, and you're up over the past 3 months about 1,000% with the cost to borrow numbers. So that is definitely telling you something at the very least. 100% share utilization. It has literally been the same for months now. Shares out on loan, 183.39 million. Free flow out on loan, 35.6%. And like I said, estimated short interest of free float, 22.9%. A look at the option activity for last week. It was not good. 9% positive order value, 422 orders, totaling $114 million. But again, you don't have to see very positive options to get a rally in the stock. You've seen this with Ape. You've seen this with multiple other companies. And in a weird way, the more option activity that you do see on any given week, the less likely it is for AMC to rally. At least that has been the correlation as of recently, guys. So there is all of that. The last thing we're going to talk about is going to be the option activity as far as the Stocko tracker data, guys. So what we're getting for this Friday is about 11,000 calls that are in the money, 38,000 calls that are out of the money, and puts in the money at 5,000, puts out of the money at 45,000. And like I just said, believe it or not, in a weird way, we don't have a lot of options this week, so it might actually open us up for an even bigger move. Now, we're going to get into a price prediction in the next video. I know this video is already very long. This is your blueprint. This is your rundown, blueprint, whatever you want to call it, for this next upcoming week. And I want you guys to use this video as a tool if you don't have a computer or you don't want to keep looking at the economic data. You could just rewatch this video, right? Write down what I'll timestamp this down below so you guys can get straight to the information that you need to really make this a tool for you. But we are going to be going over a price prediction in the next video and a deep look at the technicals, guys. So that is it for this video. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. Most importantly, enjoy the rest of your day, and I will see you in the next one.